November was a strong month for global risk assets, with the S&P 500 up 3.6%, leading the way. Expectations of some progress in trade negotiations between the US and China were a key source of market optimism, with China introducing rules to strengthen intellectual property rights. A bill which President Trump signed into law pledging support for Hong Kong protesters drew ire from China, but wasn't enough to derail developed market stocks. Ongoing anti-China protests in Hong Kong weighed on Chinese stocks, dragging emerging market stocks down for the month and leaving them trailing developed markets by over 14% year to date. US third quarter earnings reporting season wrapped up with shrinking earnings from the energy and materials sectors, dragging back the aggregate S&P 500 earnings, which ended up roughly flat, though slightly ahead of consensus. Healthcare and financial stocks were among the best performing, with healthcare stocks up over 5% for the second consecutive month. Despite this, it's still the second worst performing sector this year, only ahead of energy stocks. US bond yields climbed as risk appetite returned, with US 10-year government bonds approaching 2%, before ending the month only slightly higher at 1.8%. Higher yields helped the US dollar strengthen against most currency pairs. South American currencies were among the worst performers. The Brazilian real was down 5%, and as violent protests continued in Chile, their peso weakened another 7%, with protests starting to weigh on productivity and tourism. If you have any questions on this or to invest with Anchor, please contact us on sales@anchorcapital.co.za or visit our website www.anchorcapital.co.za.